this computer. Hello, everybody. Bob Varnum at Smart Property Management, joined by my property managers, Jeff Chatham and Katie Larson. We've teamed up
Hello.
we've teamed up with Ben Binger of Alloy Mortgage to provide a three-part webinar series, A Renter's Guide to Homeownership. This is part three, Mastering the Pre-Approval.
Pre-approval.
And this is the pre-approval master right here, Ben Binger. All you, Ben.
Thank you, Bob. If you're tuning in and you haven't watched the first couple of parts to this kind of end cap, would certainly encourage you to kind of search and find those. We're going to hit a little bit on credit tonight, but really that first episode was just chock full of good credit tips. And then we're going to kind of continue. So this is almost a part two of last week's part one, busting homeownership myths in the beginning, and now kind of taking that on to the pre-approval stage. Here's my information here. I am the owner and broker of Alloy Mortgage. If you're interested in being able to get a hold of me, there's my contact information right there. You can find me on Instagram at Bernie Bing. And with no further ado, let's go. Mastering the pre-approval, everything you need to know about getting the right mortgage without the headache. First, let's break down and talk through what does pre-approved really mean. I've been doing this for over a decade now, and I've had folks where I've said, all right, let's get you pre-approved. And they're like, no, we already got pre-approved. And I said, well, talk me through that. They say, well, we talked to a bank and had a 5-minute phone call, and so we're pre-approved. And I say, well, really what you are is pre-qualified. A pre-qualification is a quick estimate. A quick estimate, no documentation, no pay stubs uploaded, no W-2s, nothing has really been thoroughly reviewed. It simply is a quick estimate. Now, what is a pre-approval? The next stage here would be a full review of that income, a full review of credit, a credit report, looking over bank statements. This is really where if you say, I'm a serious buyer, I'm really interested in trying to find a house that I can put an offer in on, you don't want to just fly by the seat of your pants on a pre-qualification. You want a full pre-approval, a full review of everything that we know that a bank's going to be looking at, that an underwriter is going to be approving your file on. You need a pre-approval before you begin house shopping. There's many listings agents out there that say, look, it's great that you're interested in looking at this house. We're not even going to accept any offers unless we can see that there is a legitimate bank that has verified you, that has not just had a quick phone call, but done a full, thorough pre-approval on you. It strengthens your offer and shows sellers you're serious. The easiest equivalent, Bob, that I could say for the difference between a pre-qualification and pre-approval, a pre-qualification is like smiling at the receptionist at the dental office and having her give you a thumbs up. Looks good, right? Now, most of us don't just show up for a dental checkup and like, no, a pre-approval is like going in for the full dental cleaning and workup. It's making sure that a professional has actually stopped to take time to look through everything that's important. Whether you're at the dental office, whether you're looking at buying a home, doing a thorough review is important in both of those cases. So, all right. Well, let's talk about what lenders look for in this pre-approval. We're going to count out 4 different boxes here that essentially lenders or banks, those terms are used interchangeably, are going to want to see filled when it comes to pre-approval. Those boxes are income, employment, credit, and assets. And if a buyer doesn't fill each of these 4 boxes, it doesn't matter if you can fill 3 of them or 2 of them. I had somebody come to me once and they said, well, look, I don't have a job. But wait, hold on. I've got $600,000 in a bank account right now, and I want to buy a $300,000 condo. Why is that a problem? I said, well, that's a problem because you have the assets box full, but you don't have a job, so you don't have employment, and you don't have a job, so you don't have any income. So if you want to go buy that house or that condo in cash, be my I guess you got 600,000, do what you want to do with it. But you can't qualify for a mortgage if you don't have these four boxes filled with what the bank's looking for there. All right, so let's take a couple minutes and look at that first box of income. There's a couple of different ways that a bank's going to look at that. The first would be if you have a base income or something that's guaranteed. 40 hours a week, hourly W-2 pay. That's going to be guaranteed. Salary earnings. That's going to be guaranteed. Those types of incomes can be used immediately when you're looking to qualify. However, if you have any type of variable income, let's say that's tips from being a tattoo artist or restaurant or work in a bar. Maybe it's commission from a sales job you're in. End of year bonuses, part time, seasonal, second job. If you've got a side gig driving for Uber or Lyft, all of these would fall into a variable income category. So what we run into quite often is folks will have the base income and then they have some type of variable income on top of that. Well, the way a bank looks at that, again, the base income portion can be used immediately. But if we talk about, let's say, in the case of restaurant workers, well, a lot of times the restaurant workers' base is very, very nominal. They make their living off of the tips. Okay. So if someone makes their living off of variable income, then likely what's going to be needed is 2 years of history in that field or in that employ. Someone who runs their own business or their own company, depending on the length of time that that business has been in existence, a bank is often going to want to see at a minimum 1 year of tax returns. If the company has been in existence for a shorter period of time, a lot of times the bank's going to want to see 2 years of income on the tax returns so they know kind of how to average that out. The the interesting thing that I run into with buyers over and over is when a buyer comes to me, they're saying, "Hey, I want to get a pre-approval," meaning I want to know how much house I can qualify for. Is my pre-approval letter for 350,000 or 600,000 or 800,000? What amount of house can I buy? But in, banker or mortgage world, it's actually worked in reverse. How much a buyer can purchase is based on their debt to income ratio. That's the benchmark to identify what the maximum pre-approval amount is. So to kind of help you understand what that means, a DTI or debt to income ratio is a basic math equation that most loan programs are going to use to determine what your maximum loan amount and purchase price can be. Like I said, contrary to popular belief, a lender's pre-approval is based off your DTI ratio, and it actually calculates your maximum housing payment, not your maximum purchase amount. So your DTI is calculated with this handy dandy formula. There's not going to be a test, but this gives you an idea. A bank's going to say, okay, we're going to take your gross income, that's the I. We're going to take your gross income and multiply that by 50%. So if someone makes, let's say, $8,000 a month, then that 50% is going to equate to $4,000 a month. That becomes part of that DTI ratio. From there, any monthly monthly debt payments are going to be subtracted. Whatever's left over would be considered the total housing payment that a bank would allow. Let's make it easier. Let's run a scenario. Let's say we've got two buyers. We've got one that makes $21 an hour, 40 hours a week. That'd be $36.40 a month. The other makes 56 grand a year in salary. If we do the behind the scenes math on that, that means they make a little over $8,300 a month. Well, now we look at on their credit report, what are the outgoing debt expenses? Well, we've got an auto payment at $500 a month. We've got credit card minimum payments that are going out at $200 a month. We've got a student loan that has $300 a month minimum payment. Do the math on that. That means you got $1,000 outgoing in debt. Okay, so how do we put all this together? Well, we know we have 8306 as the gross income times 50% minus the 1,000 leaves us with 3153. There's not a test, but so you can see that's how a bank will calculate the debt to income ratio and what the maximum housing payment will be for a buyer. And then the bank essentially works that backwards and says, okay, if we know you can't buy a house for any more than 3153, now let's figure out how much you're putting down. Now let's increase that loan amount until we see that monthly payment hit that 3153. And now we know what the pre-approval amount is for a maximum purchase price that we can say for you as a buyer, you can go buy essentially. Okay. So next box of employment. A 2-year history is required by underwriting to see that you've been in employment for 2 years, not that you've been at the same employer for 2 years. Okay. I've seen buyers be able to close with as little as one pay stub or an offer letter from their brand new employer. It's incorrect that you have to be at the job for 2 years. You have to be at a job, some job, a history of jobs that account for 24 months of job employment history, but it doesn't have to be the same job. Okay. Now, if you're hopping in between jobs or if you have a gap, of course, the bank's going to ask about that and want to know what's going on there. That third box of credit, again, if you haven't seen our first in this series, certainly go back. We unpack that over the entire episode. But a credit score is certainly an important factor in qualifying. Depending on the loan type, it could be a minimum credit score as low as 680, 620, in some cases, even a 580 credit score. And your credit history is going to go back 7 years in the reviewal process. Just because you have something bad in your credit history doesn't mean you're going to get denied. All of that is kind of reviewed with everything else in your file. Uh,
Ben, can I
oh,
ask
yeah,
a quick question?
sure.
Does um, career change have an impact?
It can, Jeff. It more has to do with how that income will be derived. So I've seen folks that have jumped from one field completely into a different career. And as long as the term that banks are looking for is stable and consistent. So
Okay.
if the income is stable and consistent, there's not going to be an issue there. Now, here's where I have seen issues. Well, I went from a totally salaried role and now I jumped into a sales role where I get paid a base plus commission. Okay, well, the issue is there's no
Yeah.
history of commission, and so that's going to be challenging to get an approval for. But let's
Yeah.
say that you're salaried in one career and you've got this great opportunity to completely change careers and become salaried in a very different career. Well, that salary is guaranteed. It could be used right out of the gates. I've
Okay.
seen people even make cross country moves and say, look, I have a job that I'm going to have in the Denver market. Here's my offer letter. I'm not going to start that job until after I buy the house. Hopefully, Ben, can you help? Well, yeah, again, as long as you have guaranteed income, as long as there are no contingencies, I've seen a number of situations where someone can qualify with a new job before they even have started that new job.
Okay. I get
Okay.
it. I get it. Yeah.
Great question. Thank you. The last bullet point you see there, this is why it's really important. Don't wait until okay, now I'm ready to buy. A lot of times, especially if you're a first time buyer, I see we kind of need some working to get you to where you're going to be able to qualify. Maybe it's that you thought you could, but you don't quite have 2 years of the overtime or of the commissions. Maybe it's that your credit score isn't quite as high as you thought it was. For whatever reason, it's really good to try to see a mortgage banker early on to help work out any of those surprises. Surprises are fantastic for birthday parties. They're not so great when you're looking at making a decision that's going to be one of the biggest financial decisions you'll ever make in your life. That's not really where we want the surprises. Okay, so let's then also talk about it's more than just the down payment that you would need to be saving up. Be prepared and know all of the costs of buying a home. In addition to your down payment, you're going to have closing costs, depending on the bank, depending on the loan type, a number of different factors here, but you're probably looking at 2 to 3% of the home purchase price is going to be accounted in closing costs. So let's say you're buying a $500,000 home. Well, 5,000 is 1%. So you're probably looking at somewhere between 10,000 and 15,000 in overall closing costs in addition to the down payment that you're looking at bringing. What do closing costs include? Everything you see listed there: bank underwriting, title fees, government fees, insurance and property tax escrows, appraisal, home inspection, a whole bundle of different items. And you want to make sure that you're aware of that. You want to make sure somebody is walking you through and helping you be knowledgeable of that up front. I can't tell you how many buyers I've had come to me and say, okay, we've got our down payment all saved. And I said, okay, that's fantastic. But what about these closing costs? Were you aware of that? Oh, we didn't even know. Now, here's the good news. At the time of this recording, we are currently in a heavy buyer's market. That means if you want to be a buyer, you carry a lot of the cards in the transaction. One of those cards, so to speak, that you could play would be to say, seller, I'll buy your house if you'll cover my closing costs. We've certainly seen a lot of those scenarios coming up here just this year in 2025. And I think we'll continue to see a strong buyer's market for the next few months moving forward as well. But having a seller cover some of those could certainly be an option. The other thing to be aware of is there's something called an earnest money deposit. Up front, the sellers are going to ask for that. That's not in addition to your down payment or closing costs. That is credited towards your down payment. So let's say your down payment's 15 grand, your earnest money is 3,000. If you put that earnest money down in the beginning, that means instead of 15,000 down at closing, you're going to need 12,000 down at closing because the 3 grand in earnest money went towards that. When it comes to these costs and fees, plan ahead, be prepared. Your future self will thank you. Surprises during the underwriting process can kill the deal, and planning gets you the keys. Common mistakes to avoid, 4 of them that I've seen come up pretty often. Number 1, don't close credit card accounts. Keep your credit card accounts open after you've paid them off. Keeping credit cards open after you've paid them off lowers your debt credit ratio. If you close a credit card account, it may appear that your debt ratio has gone up. So don't close credit accounts. Don't apply for new credit. Don't give out your personal information to anyone who might run a credit report. Multiple credit inquiries can hurt your credit depending on a number of factors there. Third one, don't change jobs. Don't reduce your hours. Don't take unpaid time off. I had a client here just a couple of weeks back who said, oh yeah, I actually work for Flight for Life as a helicopter nurse, which sounded like a super cool job to be. And I was like, sweet, looks like you make great income. I think we're going to be fine here. And she goes, oh, by the way, I took maternity leave and I've been off for like 12 weeks and I haven't had a paycheck for 3 months. And I said, well, that's going to be a problem. Okay, so really make sure that you are careful on communicating all the details of your job to your mortgage banker. Your mortgage lender will need to verify your employment at multiple points when you're qualifying for a mortgage, and it's really crucial to maintain your employment status and income throughout that process. The last one on common mistakes to avoid, don't deposit cash. No matter where it comes from, it cannot be used towards your transaction unless you can show a consistent history of having received it over time. Again, for an example, maybe a tattoo artist or a bartender would show that, a couple times a week or a handful of times a month, they're depositing cash tips. But again, even there, cash is really problematic when it comes to buying a house. So be very, very careful about putting cash into your bank accounts. Large deposits can also be problematic. So be sure to talk to your mortgage professional before moving any money. The truth about rates. It's often just assumed that the lowest rate is the best deal, when the reality is the rate absolutely is important. But also the fees are important, the loan terms, the mortgage insurance, all the rest of the loan components that put together your loan. Make sure you're seeing a full review of all of that before solely deciding on a loan based on rate. Got a great example of this for you. We do what's called annual equity reviews. All of the clients that we've helped close on a home purchase every year on their monthly anniversary, we check in with them and say, how are things? How's your rate? How's your payment? Let's see if you can save money in lower home insurance or refinancing or what have you. Was on a call a couple months ago and had this homeowner say, hey, why didn't you tell me rates are in the 4s? I said, I don't quite understand what you're talking about. He goes, well, I'm getting mailers all the time that says rates are in the 4s. Well, I pulled up what is very easy to see interest rates. This is today's rates as we're filming this in August. But back in May, these rates were, you can see, really kind of right in this same range. Back in May, we were still in the high 6s. And I said, rates are not in the 4s. I said, what that bank is trying to convince you of is to sell you a 4% interest rate that's probably going to cost you $20,000 to $30,000 of your home equity. I said, is that what you want to do? He goes, oh, no, absolutely not. I said, that's why you haven't heard me tell you about rates in the 4s. Okay, so Just because you have a super low interest rate that someone is offering you, there's always the other side of that. You want to make sure that you're very careful in seeing what's the cost for the rate that's being offered. Always compare your options with what I would call a total cost analysis. Not just a rate sheet, but to really be able to break down, dive into numbers to see what would be the best option truly for your goals and plans. Here's what I mean. I just worked this up a couple weeks ago for a buyer looking at this 575 price point. They're looking at putting minimal down. Okay, so we put this together and I said, you know what, but let me show you a second loan option as well. So we have a conventional loan with 3% down minimum. We have an FHA loan with 3.5% down minimum. Let's compare some of the differences here. Well, it's a 6.6 rate versus a 5.8. Payments, almost a $300 a month difference. Cash to close, yep, the FHA loan is going to require a little bit more, about $2,000, well, no, about $2,500 more out of pocket. But when we look at all these factors, I said, Mr. and Mrs. soon-to-be buyers, which do you feel like is the best option for you? And they said, well, big picture, how do these compare? I said, great, thanks for asking. We ran the numbers and said over the next 36 months, the FHA loan would save you $3,700 over this conventional option. But let's back out a little further. What if we looked at over the next 8 years? Over 8 years of interest paid and mortgage insurance paid, what we found out is the conventional loan would cost almost $27,000 more than using that FHA loan. And in kind of helping unpack this and show these buyers, they said, oh my gosh, it totally makes sense. In this case, we certainly want to go with that FHA loan, which happened to also have the lower interest rate in this scenario as well. So I hope that that was beneficial in helping you feel like you have a better understanding of what it takes when you go into the process of getting pre-approved. Here's what I'll wrap up with. You don't need to be perfect. You don't need to run perfect finances. You don't need to have perfect work history. You just need a plan. And you've already taken the first big step forward by showing up to this series. If you're thinking about buying in the next 6 to 12 months, let's talk. I can walk you through a custom plan, no pressure, no confusion, just transparency, clarity, and we'll do a little education in it as well. I'll wrap up. Bob, hand it back to you. There's my contact information. You can QR code scan if you're interested. And otherwise, we can kind of keep open. If anyone here on this call's got some questions, we can kind of talk through. And Bob, it's all you.
I do have a question. What happens? You said it's a buyer's market. Can the buyer ask the seller to buy down their rate, and how does that work?
Yeah, they can. So the way a seller can contribute to a buyer is through the term seller concessions. All that means, let's take that 575,000 price point we were looking at. Let's say a buyer goes to offer 575 and they say, hey, we'll offer 575, but we want you to pay 10,000 back to us to help cover some of our costs. Okay, well, that's a 575 offer where the seller's actually netting 565 because they're giving 10 grand back to the buyer. What can the buyer do with that? Well, the buyer could take that 10 grand and, like we talked about earlier, just cover some of their closing costs. So now they have less cash that they have to bring to the closing table. The second option is they could ask for the bank to take that 10 grand and use it to permanently buy down the interest rate. That wouldn't change the cash needed at closing, but that would lower the monthly payment. So that would be a second great option. The third option that has been really popular here, I would say, over the last couple of years is what's called seller paid temporary buy downs. So what that means is instead of using that 10 grand in this example to permanently buy down an interest rate, instead that 10 grand is be using to temporarily buy down an interest rate. Now, why would somebody do that? Well, because you can get a deeper interest rate reduction, and you can get because of that, a deeper monthly payment reduction with less cost. So let's say that 10 grand is able to buy down your interest rate permanently. Let's say by $200 a month, or by half a percentage point in a lower interest rate. That's spread out over 30 years, $200 a month, nothing to shake a stick at, but it's $200 a month. Versus a seller paid temporary buy down, that first year, let's say in a 2-1, would be a 2% reduction in the rate. So if a buyer, for example, had a 6.5% rate, their first year would be at a 4.5% rate. A lot of factors go into this, but it could be up to $500 to $600 a month in savings on their payment for their first year. Then the second year, that rate instead of 6.5 would be 5.5. And in that example, then it'd be about $300 a month in payment savings the second year. Those temporary buy downs are really popular because buyers, a lot of times in this market, are thinking, hey, I'm expecting interest rates to come down sometime over the next 2 to 3, 5 years. I want the heavy load on savings to be right here in the very beginning so I can take advantage of that up front while I'm waiting for a refinance to happen down the road. So those are the three different ways that you could use seller credits.
All right, next.
Ben, is it approximately $10,000 a point, that you have to buy down? I mean, is there a math? Is there any
No,
basic
no,
math?
there's really not math to it. Um, it's it's going to be based on the bank and how they set their prices. Every bank sets their prices a little differently, and it's also going to be on the loan amount itself. So buying down your interest rate is directly tied to the loan amount. So if you have a bigger loan amount, it's going to cost a lot more to buy down your interest rate. If you have a smaller loan amount, it would cost a lot less to buy that
Yeah.
same interest rate savings down.
Okay.
I got another question, and Jeff, maybe you can answer this. In what instances could someone lose their earnest money deposit?
When they default on their basic responsibilities of the contract to buy and sell. Um, they don't show up to closing. You know, that's
That's a
um,
problem.
that's a bit. They basically don't show up to closing. They attempt to terminate based on inspection after the inspection period. Ben, what are other ones that you can just
Yeah,
make a
I
comment
would say
on?
something on that. You certainly, I'm talking to buyers here now. You certainly want to make sure you're working with a bank that very clearly knows those contract dates and deadlines and is
Yeah,
ahead of those so that it never puts you in one of those situations.
yeah,
Okay. The situations I've seen, a bank doesn't get the appraisal ordered in time. Well, there's an appraisal deadline on the contract, right? The bank doesn't get the appraisal back in time. There's a appraisal negotiation period that you have to hit.
yeah,
A bank doesn't have your loan fully approved or fully cleared to close by a certain time. Well, there's a loan availability deadline that you have to make sure you hit. So those are the ones I think from a mortgage perspective, we're always very, very hyper conscious on making sure we're staying ahead of those.
All right. Anybody else have any questions out there?
Um, just kind of last one for me. Did you have earnest money factored into the closing costs, or no, that was a separate item? The 2 to 3% of purchase price did not include earnest money.
Nope, it did
It's
not
on top
include
of
the
earnest
earnest
money.
money.
Okay.
And I was hoping I could quickly fly back to it, but I think I'll just go backwards on the slides. Should be right there. Nope, so it's not in addition to, but it was something I just said, look, it's that earnest money deposit is applied to the down payment. Okay.
Yes. Okay.
So if the down payment's 15,000 and a buyer puts 3 grand in earnest money, it just means at closing, instead of needing to bring the 15,000
Yeah.
for down payment, they only have to bring the 12,000. But yeah, the closing cost, here's usually what I see is it's about 2%. I think for factoring in, that's the most common. Certainly there are situations where condos are a little bit more expensive in there being extra HOA fees or condo association dues being prorated or paid out in advance. So I could see situations where sometimes the closing costs can get up to 3%. But a lot of times, what I see, at least on our files, about 1.5 to 2% is the total closing costs factored in for that purchase price.
Okay, great. Thank you.
Yeah, absolutely. Yeah. Oh, I
That's it
gotta
for me.
bloop, bloop,
I'm
bloop,
good
bloop.
too.
Bob,
Well,
you're on mute.
fantastic. Bob, anything else on your side, or that concludes part three?
Oh boy, I was just talking with my computer on mute. All right. So that concludes the three-part series of the Renter's Guide to Home Ownership. Thank you, Ben Binger. Unbelievable education. I've learned so much over these three-part series,
Yep.
and we're gonna have to follow up with you and get my my pre-approval, not pre-qualified, my pre-approval done.
There you go. Well, guys, it was a pleasure once again, and look forward to helping as many buyers as we can in upcoming months. Until then,
Yep.
y'all have a great night.
You too. Bye
Thank
bye,
you,
everyone.
Ben.